Now it's time to welcome our next guest, the common sense bull, Eddie Ghabour. He's the co-owner of Key Advisors Group in Lewis, Delaware. He's also the author of the Amazon bestseller, The Common Sense Bull. Eddie, thanks for being back on the show.
Thank you for having me.
Of course, the most important part of the introduction that I failed to mention is that you're not only all that, but you're also a good friend of the income generation and a very close friend of yours truly here, your host, David Scranton. So we always get all these people here on the show that are these bears, right? So as the common sense bull, I know the extreme bulls say Dow at 40,000 over the next 2 to 6 years. What does a common sense bull say, though? Do you say that's possible, or do you say that's a bunch of bull?
You know, I think anything is possible, as we all know, right? But the fact of the matter is, using our common sense approach here at our firm, I think it's too difficult to predict 40,000 based on where we are now. There's a lot of factors that have to really fall into place for us to hit that 40,000 mark. Because I think before we hit that 40,000 mark, I would expect to see some double-digit drops on the way there. So will it get to 40,000? Eventually, but I think the path getting there will not be straight up. It will be a choppy path there over the next several years.
Now, of course, we talked earlier in the show about one particular analyst who's calling for 40,000 next 2 years, but he's calling for the Dow to have a big drop below 21,000 first, then for it to turn around and skyrocket up to 40,000. Are you seeing this to be able to happen in that short of a period, such as 2 years, or do you think that's perhaps too radical of a prediction?
You know, in my opinion, I think that's probably too radical of a prediction, because one thing right now that I think people need to be aware of is we are late cycle. I've been very bullish, as you very well know, but we have definitely started to become a little bit more cautious in the second half of this year because we've had a heck of a run. And we're starting to see some red flags out there, such as the inversion of the yield curve.
Mm-hmm. So what's a bigger red flag? Is it the inversion of the yield curve? Is it the tariff, the so-called trade war with China? Is it some of the manufacturers index that have come out recently? Is it the Federal Reserve statements? What do you think the two biggest issues are right now that could cause a recession coming up, let's say, in the end of the next year and a half or so?
The two biggest things without question are the tariffs with China and the inversion of the yield curve. If we don't get some type of trade deal with China by the third quarter or even towards the end of this year, my opinion again is that I think we have a very high likelihood to see a recession towards the end of next year. That's how big of an impact this has. And then again, you have that coupled with the inversion of the yield curve. Those are two major red flags that the common sense bull right now is becoming a little bit more cautious with our portfolios and becoming more defensive, because if those two things don't shake themselves out, it's going to be a rocky road for the market heading into next year.
Well, that's what I love and respect about you so much, is that a lot of the bulls on Wall Street are just bulls, but you are the common sense bull. We need to take a commercial break. When we come back, though, Eddie, we're going to talk about specifically about the inverted yield curve and what your thoughts are on the job the Federal Reserve is doing. We also want to talk about what everyday investors can do to protect themselves at a time like this. So Eddie, please stay with us. And you stay with us too. We'll be right back here with more on the income generation. You're watching Eddie Ghabour and David Scranton, and we will be right back. Yeah, it's time to welcome back Eddie Ghabour, author of the Amazon bestseller, The Common Sense Bull. So, Eddie, the slowdown in the economy, how much of this, in your personal opinion, do you think is due to the actions of the Federal Reserve over the last year and a half?
You know, the Federal Reserve has played a huge role in this. I mean, you can just take a look at the market action just in the last 6 to 8 months based off what Mr. Powell says. And it's amazing how much they can influence markets, because, you know, one could argue that they should have been raising rates and the real rate should be back up to 5%, but they continue to get scared with the economic data that comes out. And now all of a sudden, instead of raising rates, they're talking about lowering rates 2 to 3 times over the next 12 months. So they just seem to be very inconsistent in their message.
Yeah, they're kind of giving me whiplash, I have to tell you, on this show, because On one episode, we're talking about the next rate hike, and all of a sudden, one episode later, we're talking about when the Fed's going to cut. So what, in your opinion, does the Fed need to do to get it right? To fix this flat yield curve that's inverted in some parts, to at least maybe kind of sort of help stave off a recession in some way?
Well, I think the first thing is I think they made a major misstep in December when they raised rates when everything was saying not to. And now they're in a position where they're trying to play catch up, in my opinion. So right now they're kind of been pigeonholed and forced, in my opinion, that they're going to have to actually cut rates to get that inversion from happening and becoming even steeper. Because as you well know, the longer this inversion stays in place, the higher the likelihood that we are going to be going into a recession. And anyone that ignores that, I think they're not being fair or honest to themselves.
Or they could just start reversing quantitative easing again, which they're stopping the reversal of quantitative easing between now and September. That didn't make any sense to me when they announced that. Did it make sense to you?
No. And the other thing, too, is when you look at some of the statements they've made, they tried to project out. Last time they met in March, they were projecting out 2 years and saying they were going to do rate hikes. I think trying to project out 2 years in this crazy economy is just going to prove that they're going to be wrong, and then it hurts their credibility. So I think he just needs to go month to month.
That's right. Well, you said it'd be crazy to try to, predict whether Dow is going to go to 21 or to 40 in the next 2 to 6 years. So I at least appreciate your humility. I wish the Federal Reserve shared just a little bit of that with you. We need to take a commercial break. We'll be right back in a minute. Welcome back to The Income Generation. I'm David Scranton, and we're here on this final segment with our good guest, friend of The Income Generation, Eddie Ghabour, who's also the author of the Amazon bestseller, Common Sense Bull. So, Eddie, what makes you different from a lot of our guests, our previous guests on the show, is that you're in the saddle. You're in Delaware. You're talking to average clients, just like our Income Generation viewers, every single day. So in a market today, in an environment today, an economy today, it seems to be so questionable. What are you telling them they should be doing to protect themselves if they're either retired or, as most of our audience, within 10 years of retirement?
So what we've been really talking about here recently is focusing on the equity side. We've been reducing equity exposure for clients because, again, they've had a heck of a run so far this year. And on the equity side, we're focusing on high quality dividend paying companies. One big issue is corporate debt. As you know, when we go into a recession, these companies that are over leveraged are going to have some serious problems. So quality dividends and income within a portfolio at this point in time for our client base, we feel is the main focal point of where they need to be to try to reduce volatility as much as we can as we head into uncertainty over the next few months.
So reducing equity exposure, and the equity exposure that's remaining, you're putting more into blue chippy dividend type stuff. So you're really a man after my own heart when it comes to that. I agree completely. But how about the rest? How do you, like you said, some companies that are over leveraged, you have some potential risk when it comes to corporate debt. So what do you do to protect your clients against that on the non-stock market side? What do they need to know?
So I think one thing that we've done is we've tried to focus on the fixed income side of using individual investment grade corporates versus bond funds. We feel as though there's some potential hedges there for losses. The other thing, too, is the inversion of the yield curve. Cash is actually paying something right now. And so we have a cash position right now for our clients. So that way, if we see major drops, it allows us to be opportunistic and potentially buy those dips.
It's funny. I see this, too, sometimes with my clients. I always have to remind everyone that cash is an asset class. When they see money sitting in cash, they think, why am I paying you this fee to sit in cash? When really cash is an asset class, right? And sometimes it could be the best asset class, right?
It is. And, there's a saying that says cash is king, and there's a reason why they say that.
Yep, that's right. That's right. So 10 seconds. Any final words of wisdom for Income Generation members?
Only thing I can say is this stage of the cycle with the inversion of the yield curve, with the Fed being on shaky ground and with tariffs potentially on the horizon, focus on risk management. Look at it now to see the risks you're taking. Don't wait until there is a drop to then try to figure it out.
There you have it. Some great words of wisdom from our good friend Eddie Ghabour from the great state of Delaware. Eddie, thanks so much for being back on the show.
Thank you, Dave. I really appreciate it.
And you stick with us. We'll be back with our final segment here on the income generation in just a moment.